So the secret of of the 1031, you swap and you defer until you drop. That is the key, and that is the only tax-free zone that you can see it, and the advantage of a 1031.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. My name is Bruce Weinstein. I'm the host of Ask the Planman. Everything you want to know about insurance, finance, and more. We're wrapping up our third year. We're in the mid-80s of episodes. And today I'm being joined by my new friend, Pishoy Fahmi. So Pishoy is the owner and founder of PNF Accounting and Advisors, based out of my hometown area, Central New Jersey, the East Brunswick area. He does a lot of work down here, expanding his business and working with clients in the South Florida market. And we've been involved together in the Delray Chamber. And I'm like, I've got a couple of topics I haven't really touched on yet that if you are comfortable coming on the show and talking about, I think there's some people here that could benefit from this. So today, folks, we're going to talk about what 1031 and 1035 exchanges are, how you would use and benefit them. And so I don't give tax advice, so I need my tax advisors. So Pishoy, welcome to Ask the Planman. Tell everybody a little bit about you, your practice, and then let's kind of break down what the 1031, 1035 universe is all about.
Sure. Thank you, Bruce, for having me. Our practice, basically, we've been in the accounting field for over 30 years. I had my practice now for 25 years, and we are a group of 50 professionals between CPAs and EAs. And we have multiple offices. We have an office in East Brunswick, New Jersey, and we have an office in Springfield, New Jersey. Okay. And also we have one in Boca Raton and one in Tampa. So we have 4 locations, and we're growing. And especially in this field right now, there's a lot of shortage of a good accountants. They make the CPA very hard back in the day, and a lot of young kids did not go join the profession, and therefore there's a shortage now.
We don't want to say it's boring, but
of course it's boring. But let's make it fun.
You say what's fun about insurance? Nobody wants to talk about insurance. I try and make insurance, less painful and somewhat fun. But exactly. Accounting, yes. It takes a certain mindset and skill set for what they do. And absolutely. As you know, and same with dealing with attorneys, you have to have your hunters and you have to have your minders and your grinders. So we call them finders, minders, and grinders.
Yes.
Right. So in all of our businesses, even though they might be the CPA, it doesn't mean they're going to be a good rainmaker. Right. Absolutely. They could just be a good worker bee and very studious and astute at what they do with the number crunching. But you got to get clients, right? You got to figure out ways. So that's probably why you have Tanya, that's how you and I met. Tanya's out. Yes. She does the shout out to her, the business development. So she's, I guess, in essence, kind of a quasi rainmaker for you to help make relationships. And she's been great. So yeah, that's how I got introduced to you guys at PNF, and certainly being from the East Brunswick area, I kept running into her going, absolutely. How do we not know each other? So it's pretty funny. So congratulations. I didn't realize you had the 4 offices. So that's nice. And I'm sure you don't mind coming to Florida, this time of year.
I try to find any reason to come down.
Yeah. Before we came live, I'm like, is he here? Is he down in Florida? Yeah. We could meet locally, but he's up in Jersey, trying to stay warm. So listen, I had a conversation recently with a friend who was involved in a sale of a property, and we were talking about the success and his purchase and the way he had it structured. And I threw out the comment and asked him about taxation, right? Because, and I'll just start here, is residential capital gains. It's amazing people aren't aware, and it's been over a decade, if not longer, that the tax changed. I'm in my early 60s, so being around the block, almost 40 years, is you used to be able to roll your transaction into your next home and avoid the taxation.
You can defer. Yes.
You defer. And now it's $250,000 per person, $500,000 per family or couple that is protected. So in the COVID boom, when real estate prices went ballistic, especially down here in Florida, as did in New Jersey, people are escaping the cities and escaping New York, home prices took off. So this particular friend he's single, so he could only protect 250. And so I asked him what he was doing, and how he says, no, I'm 1031 into another property. And I said, oh, interesting. Okay. And I'm familiar with it. And, but real estate's not my shtick, right? It's not what I do, but certainly I've been with clients and helped clients over the years. So when you and I ran into each other last week, I was like, hey, why don't you come on? Let's break that down. There are a lot of people that are very heavily strongly interested in getting into real estate, are doing real estate. It's overlaying into my world because people are becoming your own banker, and we could talk about that. But at its core, it's a tax code. True, 1031 is just references the tax code, as is the 1035. We'll get to that one in a minute. So that involves real estate transactions. So why don't you kind of break down with us what exactly all that entails, how it works, what people would be looking for, and then certainly where you come in if
Sure. So a 1031 is all about planning. A 1031 basically, or the simple version of it, it's a forward defer or forward rollover. You sell from the time you close. You have 45 days to identify the address of the property that you're going to be closing on. And I usually recommend list a lot of different properties that you're looking at the time. Because if it's not on the list, you cannot buy it in a 1031. So if you have 50 addresses, I don't care. List whatever you have.
That you're considering.
That you're considering.
So make your wish list.
Exactly. That's on the 45 days, because it has to be on that list to close on it. Okay. And it gives you 180 days from the time you close until the second closing. So 6 months, basically. From the time you sell to the time you buy, you have 6 months or 180 days to complete this transaction. The only difference is there is 45 days. You have to identify the property within 45 days.
So let me just clarify one thing, if I may. So we're talking commercial property, not residential.
It can be residential, but as long as it's an investment. You basically residential, you have it as a rental property. You have a single family that you rented or multifamily.
It's not I just want to,
it's not your primary home.
It's not my primary home, but yes, I can own 5 properties that I Airbnb, I rent out. I've got a year-round tenant. I got snowbirds. So it could be. Thank you for clarifying. So yes, residential, but not your individual home.
Exactly. To
avoid what we were just saying is the capital gain. So.
We can talk about this later on. I'm going to bring this topic back up because you can 1031 your primary home. There's ways to do it, but the simple version of it, let's just keep it. This is an investment, and you cannot do it on your primary home. You can do it on an investment.
Okay. Because some of the strategies, if you look at the big real estate investors out there, and we could just say Trump comes to mind, is they amass a large portfolio, and then over the years they roll up. They buy something bigger. They don't, the places they're looking for that next. So they have this movement in value. They don't want to sell it, pay all the tax. So they go look for that next property. Maybe they're going to a hotel, or maybe they're going to, a golf course, whatever it is. And so they're going to take all the value of that transaction, be able to move it into the next property, but not lose. Like it's like being umbrellaed by an IRA, let's say.
Yes.
Right. It keeps a tax deferral, but this is the tax code. So not your primary home per se, commercial, residential, but it has to be like a B&B style rental property, second, third home type of thing.
That's
and
correct.
So they have to. So this gets to avoid it, but you discussed my favorite word, which is planning, right? Exactly. So the plan man and the show, it's all about planning, and it's being proactive. So
and basically the whole idea of the 1031 is defer until you drop.
Death.
That is the tax-free, because if you sell it at any point, let's say you have $1 million capital gain today and you defer it. And then you have 5 years later, you have another $1 million. So now you have $2 million in deferred. Eventually, when you come to sell, you're going to end up, recapturing all of this capital gains.
Right.
So the secret of the 1031, you swap and you defer until you drop. That is the key. And that is the only tax-free zone that you can see it and the advantage of a 1031.
So let's explain that. So what he's referring to is your basis. When you pass away, the heir gets a step up in basis. It's with your stocks. It's with your investments in general, exactly. Real estate. So if again, we're just, I don't know why I'm using Trump, but, comes to mind as a real estate. So, Donald has whatever he's got, 4 or 5 kids. He's got that portfolio. Now, I'm sure he's got much different structure and family limited partnerships, all that stuff. But in essence, if he had one building, Trump Tower A, and he had a $50 million value and he paid $1 million, it's 80 years later, the family's not using the basis of the $1 million. They're going to get a step up at death in basis to the 50 million. And now that $49 million never was taxed from a capital gain taxation standpoint. Now there's inheritance tax and other taxes,
yes.
But the basis and again, depending on the administration, there's been a lot of back and forth as we keep changing administrations of changing and eliminating step up in basis. True?
Yes. So a lot of the administration with the step up in basis, it's been inactive for a while. And we've seen that with Biden, there's some proposition that it never passed to limit the capital gain to $1 million.
Right.
You can only defer $1 million. And again, that never passes. And now I don't think Trump will push for this, but you never know what's going to happen in the future. And that's why you just have to keep track of what kind of coming in the pipeline.
Look, there's a 3 or 4 headed dragon that most people need to have. And that's their tax advisor, their legal advisor, especially estate planning wise, yes. Their financial advisor, and their insurance advisor.
Absolutely.
Right? So the bundling and the package of all this for people is you need to have the best resources and advice available to disseminate this data, this information. And it's ever changing, right? You're in the world in 30 years. And if I took the tax code book out and put it on your table, how many feet high is the internal revenue?
Yes.
It's mind boggling, right? So to keep up with that kind of stuff as a layperson, you're playing the fool. Like you need to really. So the whole point of my show is, again, as I mentioned, is the proactivity and the planning. So begin with the end in mind. If I'm going to get involved in real estate, what's my game plan? And then what do I want to do with that property? Now, if that property has outgrown my needs, I'm looking to step up and, move into I start with a single family house and I want to get a duplex and then I want to get a 4-plex and then I want to buy, a 50-door, property. I may not want to keep the small ones. I may want to or need or want that equity. So I'm rolling that into these transactions. So now, from the execution standpoint, again, I don't know who specifically, but there's usually you can't self-deal, right? You need liaisons. And so you as a tax person, what role, what do people are seeking out? Is it you as a tax professional? I've been familiar with people who are 1031 specialists that, they hawk that as their business. What does all that entail? Sure.
So we get involved before we hire a 1031 specialist. So this conversation happens in our office all the time with my clients. What is your game plan? So we have a lot of meetings for planning. Every year we sit down with our clients and we plan. And we plan for the bigger picture, what are you going to do? And then we plan for the year. So you have to look at, a bigger picture, like a 20-year, 30-year plan. And then let's, scroll down bring it back to the 1 year. What are we doing in 25 that will fit the bigger picture? Okay. So that is part of the conversation. And one of the topics, how can we 1031? What am I going to do with primary residence if I'm over the $500,000? And one of the tricks is basically you have to flip it to an investment for 2 years or 1 year at least.
Okay.
And then that becomes an investment. And then you can now roll it into 1031. And if you have a 1031 transaction, a house that you already 1031, that can be flipped. Let's say you buy a beach house, and that can be invested for 2 years to show that, you're renting it and investing for 2 years. And 2 years later, you can flip it to a primary home. So you can flip flop between the two of them.
Okay. So let's dissect that a little bit, because there are those rules that you just mentioned. So it's like, when we played football in the street, it was like 2 in a row, 3 anyway, like to get a first down. So there's a 5-year window protocol, and you have to live in your primary home for
24 months.
24
out of 60 months.
Out of 60. So in a row, or
no?
So just 20. So
24 out of 60.
So all right. So folks, so what we're saying here is, if you're in your primary home and you want to get the capital gain, you need to have at least 24 months in that home before you're eligible.
Yes.
If you're looking to avoid the taxation event and you want to take advantage of the 1031, then literally what Pishoy's saying here is, you got to move out, you got to rent it for at least 1 year.
At least 1 year.
So
prefer 2 years to show the continuity of the business.
Okay. So you're basically taking your primary residence, you're going to convert it into a commercial property of some kind, a rental property.
Rental property, yes.
And then that will allow for the eligibility to 1031 into that other property. Now, once let's say I take my East Brunswick home, for those who know, New Jersey and East Brunswick, and now I want to go to the Jersey Shore, as you just mentioned. So, but I want it to become my primary again. So if I've 1031'd it doing that, and now I'm coming back into it, is there any jeopardy of it being invalidated if I make it, or do I need to make it or continue it to be a rental property at the Jersey Shore?
At least 2 years. So you need to maintain it. You need to show the IRS that your intent is to keep it as a business.
Okay. And
people change, circumstances change.
Sure.
So yes, I can have a business today. 2 years later, I already established that it's a business, and I decided to sell my East Brunswick home and move to the to the shore. So that becomes your primary home. As long as you already maintained a 2 years business into the 1031 transaction, you can flip it back.
So in essence, it's 2 on the front end and 2 on the back end.
Exactly.
So people realistically, to be comfortable and safe, should plan about a 4-year
that's why
window.
Always planning.
Because
this is let's do it tomorrow kind of. Right. Let's plan it right for the next 1 or 2 years. You do the transaction, and another 1 or 2 years to do the other transaction.
Okay. And then we mentioned a specialist. So a 1031 specialist will play what role in this? So it's not something you do.
No, you need
it's a third party.
A third party. You need a 1031 specialist, because he acts on behalf of the IRS.
Okay.
So you cannot take control over your proceeds. So when you come to sell, that specialist will receive the money that are coming out of the sale of your property.
Okay.
So you sell it for $1 million. The $1 million goes to the specialist, sits there until you close for the new property.
So it's an escrow.
It's an escrow, and then the $1 million
days
goes there. Once you touch the money, it's boot. You will be taxed on it. There's no way around it.
So if somebody drops the ball, and
that's it, you're done.
Okay, the transaction gets nullified. Yes. And then, assumably, the next property might be more than just the $1 million that we're using here. You
have to keep moving up.
But you can put fresh money in with the 1031 money,
yes.
right?
Yes.
Right. So if I want a $5 million property, but I've got $2 million in equity, either I can then roll the $2 million in and I can finance the $3 million, or I could put in cash. Right?
There is a rule that you cannot double.
So there's a limit.
Yeah, there's a 200% on a 1031.
Okay.
That's good.
I didn't know that.
That means you can buy multiple properties, but you cannot roll it back into, if it's only one, if it's under 3, you can get away with it. But if it's over 3 properties, you have a limit of the 200%.
Okay.
So that is the main rule. And then you have a rule also of 95%. That means you need to maintain 95% ownership of the aggregate value of the real estate. So if you're doing, let's say you're selling 1 mega house and you're going to buy 10, you need to maintain 95% ownership. You need to basically, if you're selling for $1 million, you can maximum buy it for $2 million, kind of limit 200% of the sale price.
And when you're saying 95% ownership, meaning a partner or meaning like a bank loan?
No, a partner.
A partner. So if you and I were partners and we were going to do this,
you need to maintain 95%. Basically, I have to maintain 95. If I'm doing that transaction, I have to maintain 95% of the deal, and I can accept 5% partner with me.
Interesting. Okay. So if I would think a lot of people do this through some form of LLC or other corporation. So the corporation would be the 95% owner?
You can, but basically an LLC cannot do 1031. It has to be individually owned. So if the partnership, if you and I have a partnership and there is real estate that we need a 1031, basically the planning is to take the real estate out of the partnership into your name, liquidate the partnership, and then keep it for a year into your name, and then you do 1031, and then you gift it back to the partnership or donate it back to the partnership.
This is why it takes planning. This is very, very
exactly.
It's a web. And folks, you have to understand what these rules are about to take advantage of this. But, go ahead.
A lot of other stuff that we faced with COVID, that after people are selling and they're coming to buy a real estate, and a lot of people are outbidding them. So you end up losing, the 180 days expires and you're not there and you cannot close. So end up paying tax on it. So basically, the other way to do around it, it's a reverse 1031. That means you buy first and then you sell.
And you could do that too?
And you can do that too. So it's a reverse 1031. So it's the same 45 days and 180 days rules, but it's on the back end. So you buy first, but basically you have to have enough money, enough cash to buy first, and then you sell.
Reimburse yourself.
Or you through a loan. You can borrow a loan.
Yeah.
Whatever you need to be.
But that transfer agent has to be involved in here somehow.
Exactly.
Right?
Exactly.
So you got to get the 1031 specialist agent in on the buying side, and then and then facilitate the sale.
Exactly.
And then if you have a problem selling,
and the interesting deals that we got involved with, if it's a combination between the two of them, which is blended. So let's say you're selling 5 properties and you're buying 7 properties. So some of them are going to be reversed, where you're buying first and then you're selling, and the other ones you're going to be selling and then buying. So technically, you have 180 days on the front end and then 180 days forward. So you can technically go for 1 year.
Okay.
So the 180 days, you can use some of them as a reverse, some of them as a forward. So you can drag this for a full year.
Man, so I'm glad I had you on. I've been around the block a few times, but this is great stuff. I hope the listener out there is doing this, is really sitting up in their chair and realizing like, I can't do this on my own. Yeah. And you shouldn't. You definitely shouldn't. So great stuff. Thank you so much. So I got down the reverse 1031 and the blended 1031 and the 95% ownership, and it can't be an LLC. So, great nuggets here for people to pick up on. I want to get into the 1035 before we run out of time, sure. But anything else on the 1031 that we didn't point out or make them aware of? Be careful.
This is the highlights, or this is the most common ones. The other stuff is going to be basically if, can your 401k be a partner with you and all of the stuff. So yes, we can get into this detail, but I want to talk about the 1035 first, and maybe we can go back.
I think if we're going to get into 401k stuff, we got to do a whole nother show.
Exactly.
I got a lot of questions I can think of for that one. So, and I'm always wondering how people are doing certain things when I run into them, where they're taking their 401k money and buying life insurance and other products. And I'm like, how are you getting away with that? So, but let's see if we get on the calendar and do another show on that one. But so folks, 1035 been more my world in my 39 years as a financial person. And at 1035 had to do with life insurance and annuity proceeds, cash values that have built up. And the familiarity for me there is you could move from like to like. So a 1035, if I've got a lot of cash built up in my life insurance, way back in the day, people did whole life. Now they use universal life. Obviously, it's not term insurance because there's no cash value. But if somebody's built up some equity in their life insurance, and then at that stage of their lives determine they don't really need or want the life insurance, and they've got what we used to refer to as trapped cash, is, I don't want it going, I don't want it burning through as the insurance gets more and more expensive. I want to get out that capital. Well, there's a basis to that, just like a real estate transaction. And so if there's a capital